the amount of money is growing. Well, there's money everywhere. We can do stuff. Now, it means that it's easier to borrow money from your bank. It's easier to get a mortgage. It's easier to do all sorts of other things. But it also means that businesses have easier access to capital. Banks are not hoarding capital as much. So it means that money flows throughout the financial system. We're a system based on leverage and liquidity. So when money supply is shrinking around the world at the same time, it means that it's going to pull down all assets. And in fact, when we look at it, the bond market has lost $19 trillion in value globally.
Hello, and welcome to Wealthy Value. In today's video, Real Vision's co-founder and CEO Raoul Pal updates about the present situation of the global economy, his macro thesis on upcoming recession, and why he believes that crypto markets have already bottomed. Raoul also gives his macro outlook for cryptocurrencies and reveals why Bitcoin and others are retesting the lows right now. Make sure to stick around till the end of this video, where Raoul explains why liquidity going down is bad for assets. If you like the video, don't forget to give it a thumbs up, subscribe to the channel and turn on the post notifications. Let's dive right into the video.
So the economy is about to go off a cliff. And I don't think the market is yet prepared for it. So let's go back to this Jackson Hole thing. What did they tell you? They didn't tell us anything new. They said, we really want to get to 4% and hold it there depending on the data. Well, the bond market, if I look at euro dollars or Fed funds, they're already at 4%. So the market's priced that. So there's nothing new. So I think, okay, there's nothing new there. So if the economy starts getting weaker, because the Fed said they will be more data dependent, then we'll see the bond market starting to price in lower rates in the future. So I'm looking at that. And then the Fed said, well, they will change their mind if inflation comes down a lot and unemployment goes up. So the forward-looking inflation data is already falling fast. My work suggests it could go negative in 18 months, which is something I've been talking about a while when I've been looking at, for example, the example of 1947, when people all came out of World War II, went back into the labor force, much like the pandemic. We had no supply because nobody was making everything because everybody was at war. We had this, prices went up 20%, 18 months later, negative 3%. Then it had a rebound effect and then balanced out. I think we've got something similar playing out now, which is contrary to the narrative that we've got sticky inflation. Everyone looks at the 1970s, that's what we're doing again. Unless the Fed crush it, they're Arthur Burns and we're going to ruin it. Well, in the 1970s, we had this massive demographic boom that kicked in just at the wrong point, which was the baby boomers entering the workforce. We have the opposite. We have in 2023, the record peak number of people hitting 65 in the US labor force. And that means peak retirees. So we've got peak retirees happening, and we've got demand destruction driven by this economic cycle. So the forward-looking inflation data to me looks like, if I look at commodities, I look at a bunch of things like new orders versus inventories in ISM.
A lot of traders are losing money on the falling markets, and cryptocurrency market is unpredictable, and the bear market could win over the bull market. So how can you earn profits in a bear market? Diversify your trading strategy by trading on Margex and utilize long and short position. Welcome to Margex. It is a Bitcoin-based multi-asset trading platform. You can earn profits by opening long and short positions even in a falling market. BTC and other top cryptocurrencies are available at 10x leverage. There's no know your customer, and Margex has been nominated by Finance Magnets as the most user-friendly trading platform. Margex also features a killing MP Shield feature, and that's a system that protects traders from illiquidity and price manipulation, like the flash price crashes and the liquidate short or long positions often conducted on competitor platforms. Margex also gives you the exclusive bonus to try leverage trading without any of the risk involved. You can sign up on Margex in a minute using an award-winning interface. So to do that, just sign up on Margex. Make sure to use my link in the description below. Join the wallet section. Then you can enter my promo code in the promo code section, which I'll show you how to do that. You just hit use promo code and then go ahead and enter the promo code in that section. Then you get $100 free funds to trade and test your trading skills. Every Margex user can trade BTC, Ethereum, LTC, XRP, EOS, ADA, UNI, SOL with up to 100 times leverage. The minimum deposit is only $10 and the minimum trade size is $1. Margex users can pick between cross-margin and isolated margin for each trade. Cross-margin shares the trader's available balance among all open leverage positions that use cross-margin. To go ahead and open a trade using cross-margin, simply head to the Order Submission menu and click on the leverage method used, either using the pen or scrolling all the way to the left on the slider. As you can see, Margex trading fees are extremely competitive compared to other major crypto exchanges. The low fees are pretty amazing to behold, especially considering the MP shield that makes trading much safer than other cryptocurrency derivatives and trading exchanges. In addition, it is possible to use 10 cryptocurrencies as a deposit position. Margex offers BTC, USDT, USDC, DAI, ETH, Link, WBTC, USDP, Tron, and Polygon as available collateral. So, what do you need to do? Let me remind you how the promo code works. Sign up to Margex using my link in the description. Join the wallet section, then enter my promo code in the promo code section. And then perfect. Get $100 free funds to trade and test. Thank you very much for watching this, and I hope it was helpful to you.
There's no certainties in this world. I can be wrong, but my view, the balance of probabilities are for me that the risk asset market, equities, crypto, have bottomed. We are having a retest, and as the economic data shifts and bond yields come down, that'll drive that further, and it'll be a further hated rally because nobody will understand. We're going into recession. Why are equities going up? Well, because they already priced the recession. It's their job to be forward-looking indicators. So that's kind of the big picture framework. And then we'll see on the other side, when you've got this yielding asset that is a giant in the space, what that unlocks in terms of DeFi, the opportunities for institutions to invest, and other opportunities that come from a different asset. Also the ESG credentials. You know, we all know that Bitcoin ESG credentials are not what the ECB or others will tell you, but that's the narrative that's won the institutions now, that Bitcoin bad, but proof of stake, good. So I think all at the margin, it helps people allocate. We've lost something like 40% of global GDP in this pullback. I mean, that's a lot of wealth that's been destroyed. And that's without interest rates getting very far. I mean, the US interest rates are 2.5%. and bond yields are at 3%. But that's the problem of a leveraged market. So when you take liquidity away from a leveraged market, if you're paying the interest on your loans and you're not got enough money, so imagine you're trying to pay your mortgage, but your salary keeps going up and down. So i.e. the amount of money you've got is suddenly less, which is what's happening with inflation. It's harder to pay your mortgage. So you won't borrow or spend as much money. That's what liquidity does. I know the Fed want to get to 4%. But my work suggests that the economic data will fall apart too fast for that to happen.
This is federal funds rate for people who aren't following this as close.
That's right. So that's the official interest rate from the Federal Reserve. I don't think they will potentially get there because the economic data will fall apart faster. So maybe they do a 50 basis points in September, and then they're kind of like, do we do 25? Do we just wait and watch the data? Because they've said they'll go data dependent. And if the data falls apart, 2 months is not a lot of time. So maybe they get 2 rate rises in, maybe they only get 1 in. I think it's going to be difficult if I'm right about the economic data this month. I think it's going to be really hard for them to do 75. I think they'll go 50. They've already said it's 50-50 anyway, whether they'll go 75 or 50. And then we should start to be getting to the grips of the massive slowdown in the economy that I foresee, and therefore they might not get to the 4%. But they will pause and wait. They're not going to cut immediately. That's not going to happen. But they're going to pause and wait. The Eurodollar market and Fed funds market says they start cutting next year, and it keeps moving around when they start that, but that's what they're thinking. The other big part of the equation is the dollar. The dollar is the key asset of all assets. It is 80% of all world's trade is priced in dollars. So if the dollar goes up or down, it matters. The dollar is driven by global liquidity as well. And there's massive dollar borrowings around the world. More people borrow in dollars than any other thing. So when liquidity is drawn away, people scramble to pay back their loans, and then countries go bust, like Sri Lanka did, and places like Colombia have been running into trouble. So the dollar has been on this screaming bull run. It's now the second biggest bull run since 1996. I'm not sure it's yet peaked. It will do when monetary conditions back off significantly, but we're not there yet. Even if rates come down a bit, it's not clear the dollar will do it because Europe is a big drag, China's a big drag. There's some real issues out there in the global economy that means the dollar is still the kind of shiniest currency. It can't be a black swan by the very understanding that we all know about it. Black swans are risks that we don't understand. So for us, at best, it's like, when does it happen? Sorry, at worst is when does it happen? At best is maybe it doesn't happen. So we all understand the risk, but it's geopolitics. We have no idea how this plays out. I understand that the Russian situation put it to the forefront of people's minds, and it's definitely a possibility, but I don't think China wants to cut itself off from the world. And I don't think the US wants to cut itself off from China yet. So I don't think it's in anybody's interest. It's kind of this stalemate situation where it kind of rises up. It's like North Korea, South Korea. It's not a solution where anybody actually wants to pull the trigger, but they want a position until maybe they can find an opportunity one way or the other to resolve it.
So, do you think that the crypto market is retesting the lows? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.